Welcome back to Simple Mind Space, the podcast dedicated to helping you master your money and your mind. Today, we're diving deep into the world of market makers, those often misunderstood entities that play a pivotal role in the financial markets. Now, if you've spent any time in the market, you've probably heard whispers, rumors, even outright horror stories about market makers. They're often portrayed as puppet masters, manipulating the market for their own gain, leaving us, the average investors, holding the bag. Remember the Gamestop saga? The chaos, the confusion, the feeling that something wasn't quite right? Well, Citadel, a market maker, was right in the thick of it, allegedly pressuring Robinhood to halt trading. That's the kind of reputation market makers have, and let's be honest, it's not entirely undeserved. But here's the thing. The concept of market makers wasn't born from malice. It was designed to ensure smooth and efficient market operations, benefiting both institutional giants and individual investors like you and me. And you could argue they still achieve that, despite their less than stellar reputation. So, let's unravel this enigma, shall we? At its core, a market maker is an individual or institution that partners with an exchange to enhance liquidity. Imagine a bustling marketplace, but instead of fruits and vegetables, we have stocks and bonds. Now, for a market to function smoothly, there needs to be a steady flow of buyers and sellers for each item, right? But what happens when there's a sudden surge in demand for, say, apple juice, but not enough sellers are willing to part with their precious beverage? That's where our market maker steps in. They act as both buyers and sellers for all securities traded on the exchange, ensuring there's always someone to take the other side of your trade. Let's say you want to buy 1,000 shares of a particular stock. Instead of waiting for another investor to match your order perfectly, the market maker swoops in, ready to sell you those shares from their own inventory. Conversely, if you're looking to sell, they're there to buy. This constant availability of buyers and sellers is what keeps the market liquid, allowing you to buy or sell your investments with ease. But how do they make money? Well, market makers don't buy or sell at the exact market price. They have what we call the bid and ask prices. The bid is the price they're willing to buy at, and the ask is the price they're willing to sell at. The difference between these two, the spread, is their profit margin. So if a stock is trading at $10, the market maker might offer to buy at $9.95 and sell at $10.05, pocketing a small profit on each transaction. Now, for high-volume stocks like Apple or Amazon, this spread is usually minuscule, often just a penny. But for less traded stocks, the spread can be wider. While this makes it easier for market makers to profit, it's not always a walk in the park. Stock prices fluctuate constantly, meaning market makers often find themselves with long or short positions depending on market movements. However, seasoned market makers aren't looking to make a quick buck on every single share. Instead, they focus on their net position, the difference between their total long and short positions. They aim to maintain a favorable average price for this net position, ensuring they're in a profitable position overall. So far, it seems like market makers provide a valuable service, right? But here's where things get murky. Over the years, some market makers have resorted to less than ethical tactics to, let's just say, nudge the market in their favor. One common tactic is what's called bear or bull rating. This is essentially a coordinated effort to push a stock's price in a particular direction. For instance, a market maker might aggressively sell a large number of shares, creating a mini panic and driving the price down. Once the price drops to a certain level, they swoop in and buy those same shares at a discount, profiting from the artificial price drop they orchestrated. They can also do the reverse, buying aggressively to inflate a stock's price before offloading their holdings to unsuspecting investors who jump on the bandwagon, only to see the price plummet soon after. Another trick up their sleeve is spoofing the tape. This involves placing large, fake orders to mislead other traders. Imagine seeing a massive buy order for a stock, signaling strong positive sentiment. You might be tempted to jump in, fearing you'll miss out on a big move. But just as the price starts to climb, the massive order vanishes. It was never real in the first place. The market maker who placed that phantom order has manipulated you into buying, and they can now sell their own shares at an inflated price. Earnings season is another playground for market makers. They know, though, that even seasoned traders tread carefully during these times, as predicting market reaction to earnings reports is a fool's game. Market makers use this uncertainty to their advantage, sometimes selling off a stock ahead of a strong earnings report, only to buy it back at a lower price once the good news is out. Or they might do the opposite, pumping up a stock before a disappointing report, knowing they can profit from the inevitable drop. Now, a relatively new concern in the world of market makers is payment for order flow. This is where brokerages, particularly those offering zero-commission trading, route your trades to specific market makers in exchange for, well, payment. On the surface, this might seem harmless. After all, you're not paying any commissions, right? But here's the catch. When brokerages prioritize payment for order flow, they might not be getting you the best possible price for your trades. Remember, competition among market makers usually ensures you get a fair price. But when a brokerage is financially incentivized to send your order to a specific market maker, that market maker has less incentive to offer the most competitive bid or ask price. This lack of transparency can hurt your returns, especially if you're a frequent trader. So where does this leave us? Market makers, despite their sometimes questionable practices, are an integral part of the financial system. They provide liquidity and ensure efficient market operations. However, it's crucial to be aware of their potential for manipulation. If you're a long-term investor, market maker shenanigans might not impact you as much. But if you're a day trader or swing trader, it's a whole different ballgame. Understanding their tactics can be the difference between profitable trades and painful losses. And remember, the best way to avoid getting caught in their web is to invest in quality companies for the long haul. Don't get swayed by short-term fluctuations or fall for manipulative tactics. Stay informed, stay vigilant, and as always, happy investing. That's it for today's deep dive into the world of market makers. If you found this episode insightful, don't forget to hit that like button and share it with your fellow investors. And for more myth-busting explorations of the financial world, subscribe to Simple Mind Space. Until next time, take care of your money and your mind.